Hi, I'm Joe Morgan, your flat fee financial planner from Best Financial Life here in Danville, California. And I'm sharing some money moves that might be appropriate for you. At Best Financial Life, that's what we're trying to do, build your best financial life. And that always starts by getting clarity around your current situation so that we can have control to make the best decisions that we can. The information I'm about to share with you is, of course, free. But before we get into today's topic, I have to say that this is not financial advice. Financial advice should be specific to you and your situation. And I don't know you. I don't know your situation. These are just some general concepts and money moves that I'm sharing these days. If you are thinking about getting some help, I may or may not be the best fit for you. I don't know. I mostly work with independent thinkers who want to solve for their long-term financial life and really optimize things over the long run. And people who learn through discussion as opposed to, I never give my clients a thick book to read or a dense article. We talk things out and try to figure out what's best for them together. So if you think we might be a good fit, you can reach out to me. My email address is joe@bestfinlife.com. Um, if you, okay, so enough of that. So let's get into the main topic, how to manage your RSUs. So first off, what is an RSU? An RSU is a restricted stock unit, which means that you have some ownership in your employer. Now, these are normally given out as part of compensation year after year, and they vest over a certain period of time. And they're like a delayed bonus payment in that sense. So you get awarded the stock today. It doesn't vest, maybe 25% vests next year, and then the next year, and the next year. So maybe it vests over 4 years. So you get the actual quote unquote bonus over those 4 years. And we don't know how much money it's going to be because it depends on what happens to the stock between now and then. So that's basically what an RSU is. What I want to focus on today is when should you sell the RSUs? And that's important because we normally just allow these to accumulate and they just sort of build up. But eventually we want to sell them. And so let's talk about when we want to sell them. So first off, I would ask you to review your exposure that you have to your employer. And I would do that in two ways. First, add up all the stock that you have, vested and unvested, and divide it by your total assets. And if that number is over 10%, I would say you're overweight in your company's stock. You're undiversified. And we never want to be undiversified. Now, um, the second way that I would look at that is realize that your income also comes from your company. So if your company falls on hard times, not only might the stock go down, but your income could go away. You could get laid off. Certainly not unusual these days. So if we have over 10% exposure, I would say that you want to sell. Otherwise, you are gambling. You are really risking your financial life on that company's well-being. Some people choose to do that. That's fine. I don't help people do that because I think it's too risky. But some people can choose to do that. So let's talk about selling. So what's the plan for selling? Well, for unvested RSUs, as they vest, we want to sell them immediately as they vest. Now, why is that? Well, when an RSU vests, you pay tax on it. So from the day it vests, the tax slate is clean. There's no reason to hold it going forward. It's as if the company paid you cash and you turned around and bought the stock. Now, I'm willing to bet that the cash bonus that your company pays you, you're not rushing out to the broker to buy stock in your company. So why would you keep the RSU? There's really no reason for it. It's set up that way to create some momentum so that people do hold on to the stock, right? That's why they don't give you cash. They give you stock because they want you to have a share of the company. That's fine. I just want to make sure you don't have too much of a share for your situation. So for unvested RSUs, as they vest, we want to sell them. Okay, that's fine for that. Now, what about this lump of already vested RSUs that you have or you might have? Well, for those, you want to calculate the tax cost to selling them. So there's no tax cost to sell them if you sell immediately as they vest. But now that we've held them, we might have gains, we might have losses. there's some tax effect going on there, and they're going to be taxed at different rates depending on whether they're long-term holdings or short-term holdings. So basically, depending on how long ago they vested. So we want to calculate as a percentage, what does it cost us to sell each award that we've received, each lot as it vested? And that'll tell us the percentage tax cost and the total tax cost. Now, if that total tax cost is too much to take in 1 year, we might want to spread it out over 2 or 3 years. That's perfectly fine. But to do that, we want to sell in a way that we sell the most value of stock per tax cost. And that's why we created that percentage calculation. So we're going to sell the lots first that have the highest value and the lowest tax cost and work our way down the stream. And we're doing it by realizing, an equal amount of the tax cost each year. So if we're going to sell over 3 years, we're going to realize a third of the tax cost this year, a third next year, and a third the final year. And that's how we're going to work out of it over time. Now, the other reason that I've heard people say that they're unwilling to sell is they don't know what to do with the resulting cash. They're afraid they might spend it or it might go away and just not sure what to do with it. Well, we should already have in place a system for our cash. Now, remember, these stock awards are regular compensation. They're just like your salary. There's no difference. And I can prove that to you. And here's how I can prove it. If your company said tomorrow, you know what, going forward, we're not going to award any more stock, and the unvested stock, the stock that hasn't vested that you don't really own yet, we're going to make that void. We're just going to get rid of the whole stock program. Let me ask you a question. If your company said that, would you be thinking about looking for another job? I bet you would. So this stock is simply part of your overall compensation package. It's not a windfall. It's not lottery winnings. It's not, real bonus money. It's part of what you get paid for the work that you do. So if it's similar that way to your salary, then we want to treat it similarly. We want to bring it into our financial life in a similar way. And the way I do that with my clients is this. We want to make sure we are hitting our savings target first. Now, our savings target is based on two things. First, it's based on our net cash needs over the next 5 years. And second, any emergency savings that we want to set aside. So we want to make sure we have the right amount in our savings. Once we have that, everything else goes into our long-term investment plan. Not necessarily for retirement, but just to be spent 5+ years going forward. So it all goes into our investment portfolio, which we've developed in another part of the financial planning process, what I call the best breakthrough process. So that's what we do with our cash. Treat it like any other income, any other salary income that we get. So what gets in the way? Well, there's a classic behavioral issue that gets in the way. And this is how I can best describe it. If your stock is going up, 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 you're likely to, and you're watching that and thinking about it, you're likely to think, you know what, I don't want to sell. It's going up. Why would I sell? It continues to go up. And if your stock is going down, 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 you're likely to think what? You're likely to think, gee, I don't want to sell. It's going down. I want to wait till it gets back up where it was. So if you're not going to sell when it's going up and you're not going to sell when it's going down, when are you going to sell? The answer is you're not if you follow that model. It's a poor model, but it's the way we think as human beings. It's a behavioral issue that we all have. So that's why we need a program or system to tell us when to sell those RSUs and get that money out of an undiversified position and into our diversified long-term investment plan. So that's what we've talked about today. Here's the good news. You can make this really easy. Again, as I said, sell the RSUs as they vest. And then for the other RSUs that you've held long-term, make a tax smart plan for getting rid of those. That's all I had today. That's how I would suggest you manage your RSUs. I hope you enjoyed this video. And if you have any topics that you'd like me to cover in the future, please let me know. Thank you.